Here that's hosting this event. Uh, Before we get started, I'd love to introduce you to our Associate Vice Chancellor for Innovation and Commercialization, who basically manages the office and the innovation programs here. And he'll kind of talk to you just so you can see it. And many of you, since we're just starting the school year right now, we want you to know what we do here at the Office of Innovation and how we are here as a resource for anything you might do in entrepreneurship and innovation and explore it. So, Paul, do you want to just come up and say hi?
Hi, everybody. So my name is Paul. First of all, welcome to a new school leader year. Exciting, huh? Oh my God, is that about as enthusiastic as we can get? Everybody's really excited about the new school year. Okay, very good. Yeah, so I run this building, I guess. So as Greg said, we just wanted to really introduce ourselves and let you know that there are a heap of resources. If you're interested in entrepreneurship, which obviously you are, you wouldn't be here, right? There is everything you could possibly need in understanding entrepreneurship, in building out your networks of everybody that you're going to need to be able to do this, in getting all the resources together to develop your products, your services, whatever your solution happens to be, and put companies around them. You should never feel that you have to figure this stuff out by yourself, because you don't. There's somebody here in this building, and there's places all over the campus, if you don't know that already, to also help you do that. So that's really why I'm standing here, is just so that you know who Greg and I are. You can definitely come to us at any point in time, but come to anybody in this building. I'm not going to go into all the stuff. But one of the big parts of entrepreneurship is building out your networks, meeting people, getting out there, putting yourself out there. And so this is really part of what this series is all about, is to understand how other people view the world of entrepreneurship, and to bring them in, and so that you can directly interact with them. And so we're delighted today to have Scott. He's going to introduce you, obviously. I'm not going to do that. I'm just going to thank you for being here. Without people like Scott, we really couldn't do any of this stuff. It's really what brings value to all the programs that we do. So I'm very thankful that to have you down here as well. And with that, yeah, don't be a stranger. I'm glad to see so many of you here for the first time. Do come in. There's programs, events, all sorts of stuff all over the place. I'm sure Greg will tell you about them. And please do participate. We're here to help you. So thanks.
And understand that we pride ourselves on not being the smartest people in the room. That the reason that these programs we do work is because we rely on mentorship and experts that come from outside. A lot of our programs are practitioner driven, so you can hear directly from the entrepreneurs and investors who actually back and create companies, and you can ask them a lot of real questions. These programs that we do are meant to be conversations, not lectures. And so we would encourage you today that when you have a question, please raise your hand. What I will ask you to, and when we get to the Q&A portion, we will have a microphone out. We'll bring it out to you, is we ask you, first of all, just to give your name in any brief context. We ask you, when you do make a question, please put it in the form of a question as opposed to maybe a long speech about something you're doing. And that way we can get in as many questions as possible. Um, and we also realize that entrepreneurship in general is a body contact sport. You learn it by kind of putting yourself into the game and really kind of making contact with as many people and as many opportunities. It's about falling down and just as many times, even more times, getting up around it. And so by hearing these stories today, you're going to learn as much by what didn't go well as what did go well. And so please lean into the questions. When we've done these programs in the past, we found out that the questions from the audience are actually the best part of the program. So we actually encourage you to kind of be involved, and also realize that this is a start of a conversation and a start of an engagement with us, not the end of it. So we hope you'll come back early and often in working with our programs. Make yourself known, make yourself familiar, and realize that we're here to make connections and introductions, not to kind of create bottlenecks for what you're doing. So at this point, I'd like to invite up Scott, who's going to be our guest tonight. Scott and I have known each other for a little while. Scott is, as he will give you his background, I won't kind of spoil the story, but as someone who's, again, one of these seasoned people who has been in the market, has done the startups, has invested in them. And so you're going to learn a lot of practical and practiced wisdom from what he's done. But you're going to also hear some pretty hard truths about kind of where we're at right now and what it looks like going forward. And we hope you can encourage you to, that it, rather than it kind of discouraging you, it does exactly the opposite. It encourages you So let's get started with this. And Scott, I will turn it over to you.
Thanks, Greg. Um, Thank you guys for having me. Should I use this mic or this one, or does it matter?
Doesn't really matter.
Thank you guys for having me today. Thanks for coming in on such a beautiful afternoon. I know the bar is high here to entertain you guys, so I appreciate it. And I do want to say how lucky you all are to have Greg and the leadership here. It's you don't know how lucky you are. As soon as you walk out of the doors and you graduate, they're not at your beck and call anymore. Sure, you can work the alumni network, you can try to go to a directory or something, but to have the expertise that they have and the willingness and the desire to support you guys, you're never going to see anything like that again going forward. So take advantage of it. And the fact that there are a lot of hands went up your first time here, that says a lot. You guys are taking advantage of it. Get time with these guys. Chase them down. Bug them. They're here for you. Even though they're busy, they're here for you. So you guys are super lucky. So just to get a sense, how many are undergrads? Raise your hand. Okay, and how many are grad students? Okay, and how many of you are graduates or alumni? And how many of you are entrepreneurs that are not in school anymore, building a company, venture capitalists? Okay, cool. This is a great mix. So this will be a fun conversation. I'll give you like my quick journey, the path, because it's every journey is atypical, but hopefully what you'll take away from the journey is no one invited me to the party. Like I kind of hacked my way to wherever I am. I'm not even sure where I am, to be honest, and where I'm going. But the point being is every journey is your own and you have to make it happen. I had to make mine happen. So I was born in Indiana. I went to high school in Indiana, growing up in Indianapolis. I don't know if have you ever been to Indy 500 or do you just think it's a cool t-shirt? You've been to the Indy 500? You just think it's a cool t-shirt? Yeah, it is cool. The race is actually pretty cool too. So I grew up going to the Indy 500 race every year as a kid. And then I was weirdly kind of recruited to go see this school in Boston. My parents, my sister, they all went to school in Indiana. I went out, I was recruited to go look at Boston College. I went to BC, had a great time. I've been coding, by the way, since I was 12 years old. So I grew up just super curious in programming computers. And then when I was at BC, the dean was like, you should transfer. So I transferred to Harvard. I finished up a couple of years at Harvard. And then I wrote a thesis on affordable mortgage lending. It's like a do-gooder, like how do we get money into the people that can't get mortgages through the normal path? The investment banks picked up on that and they're like, wow, a Harvard kid can spell mortgage. So I started in fixed income derivatives. I then moved into tech banking because I was like, okay, I'm not sure where this derivatives things is going and I want to be Gordon Gekko from the movie Wall Street. So I'm going to move over to M&A and be that guy. I did that for a couple of years. I was like, I want to start a business and maybe I'll go work in asset management or maybe I'll go to get my MBA or maybe I'll stay at Goldman as an associate. I built like basically a linear regression model to put in a bunch of weights on a bunch of things of everything from like how much money am I going to make next week and how much money am I making in the future and am I going to meet my wife potentially and all. And then I weighted each one of those and I hit F9 and it said go to business school. So I went to business school and I met my wife who's sitting over here. So that all worked out according to the formula. I finished business school and I moved to San Francisco to start a company. I ended up joining one. It was pre-Google. So we came up with a model for internet search that was based off of Yahoo's model. It was pretty cool until it wasn't. Google came and cleared our clocks, but we did go public. We were a $7 billion market cap. And here I was like 2 years out of business school as a Section 16 officer of a public company. Had no idea what I was doing and definitely wasn't worth what the paper suggested I was worth, as I quickly learned when the price went down and the bubble burst. There was this lockup thing. So yeah, I took a little bit off, but nothing to, nothing like I thought I had. And then I went back to Goldman. And at Goldman, I was investment banker for 10 years, but I also had a fund because I was sitting there as like an intrapreneur within Goldman. I was looking around saying none of these companies are going public, but I could put capital to work. And so I started chasing different companies while I was at Goldman. Those companies ended up being Facebook, Airbnb, Uber, Palantir, Square, DST, which is like the internet of Russia. I didn't invest in Yandex in Russia. Zappos, which is a shoe company that Amazon bought. So I had a great run, made the firm over $1 billion and made a lot of friends. And then I went out on my own about 12 years ago, started my own firm. It was called Sherpa Capital initially. My original co-founder exited. That was interesting because it tripped Keyman. Not many GPs or venture capitalists can sit around and say, I still am in venture capital, and we tripped Keyman. Got through that, recrafted the firm as Acme Capital. We're now $1.4 billion under management. We do like $300 million funds focused on deep tech. What is deep tech? It's basically not consumer, not e-commerce. It's not the stuff that I used to love investing in because those things are really hard to make money in, or at least they have been for the last 5 or 6 or 7 years. So it's aerospace and defense, it's synthetic biology, it's robotics, all the stuff that I loved from all the science fiction I read. But I just put a post out on LinkedIn this morning about how different deep tech investing is, in particular aerospace and defense, than other types of investing. It's very different. So if you're interested, you could read that, or we could talk about it in Q&A. So, and now I'm sitting here. I met Greg. I can't remember where we met. It was one of my sci-faction dinners, maybe, or? That's right. It was Carl that introduced us. It was at an event, and I just gave a whole talk, few familiar faces about networking and building your network. And we met at an event and then hit it off. So that's my story. And hopefully what you take away from that is a couple things. One, I've been an operator. So I didn't exactly start my own company, but it was pretty darn close. I've been an advisor. So I've taken tons of companies public. I've sat side by side with the Zuckerbergs of the world and the Travises and you name it, and worked closely with them to take their companies public and raise billions of dollars. And then I've had to be on the other side as an investor, evaluating thousands of companies. I've probably done about 250 investments. And what I hope to do in this session is give you a little color about what's going on in venture capital. So that's some high level stuff. And then I'd love to kind of pierce the veil and just talk about what I deal with every day and how easy it is from somebody on the outside to take something personally or try to read into the things that we venture capitalists do, when in fact, we're just as confused as you are. And we're also being told no way more than you are. You think it's rough, right? You're like, I pitched 20 VCs and they all said no. Well, I pitched like 200 LPs. Those are the people that give us money, and they all say no. And it's just part of the business. So one big lesson is get used to being told no. And if you're really precious about your ego and can't be told no, go find a different career. Because if you're an entrepreneur, you're going to be told no. If you're a venture capitalist, you're going to be told no. And it's not just from the LPs. You're going to be told no by your partners. You come back and you're like, I found this really cool company and I think they're super exciting. And your partners are like, ho hum. You're like, depending on what your voting structure is like, it's very easy to be told no by your partners. And you get told no by founders. I had a founder I was super excited about, flew across the world, spent a bunch of time with him, and ended up not getting the deal. Super frustrating. And if I went home and just like licked my wounds and just sat there and stared at the mirror and said, gosh darn it, you're good enough, like that, you got to just go, get back up and go back out fast. It's about reps. So anyway, a lot of little lessons like that. But I thought it'd be helpful. I put a letter out to my LPs a couple of years ago. And I said, guys, this is going to change. Venture capital is going to change. And our LPs stand for limited partners. Those are the people, big pension funds, big endowments, family offices, billionaires. They give us money. And then we take that money and we put it into founders. That's how the model works. So we've got to go raise money, right? So I sent a letter to these guys. I'm like, I'm not sure how this is going to shake out, but venture capital is changing. And the data doesn't lie. And so I put that letter out, and it was a private letter, but nothing's private. And Business Insider picked up on it. And they're like, we got your LP letter, and we're going to run it. I'm like, fine, run it. I don't care. And so they ran it as a story, and it became news. This was like late 2024, early 25 maybe, end of 24. And it was like headline news, whatever. Not headline, but within our little world. And then I decided, okay, fine. There's a whole deck that Business Insider didn't have. So I was like, fine, I'll just put the deck out. And so I stuck it on my LinkedIn. Some people saw it, some people didn't. But I have some slides. I'll click through them pretty quickly and give you this context of why I think the world is very different. And then let's get Greg up here and we can have a chat. And more importantly, as he said, hear from you guys and ask the really, really, really hard questions, because I can guarantee you I don't know the answer, but we can maybe kind of muddle through it together and debate kind of the pros and cons of it. Oh, awesome. Thank you. So with that, cool. So this is a snippet from my annual letter that I sent out. So I guess it was February 24. And I said, the changes are systemic. That's a really important point. They're cyclical and systemic. Cyclical comes and goes. Systemic means the system changed. So I said, these changes are systemic. We're entering an entirely new fourth era of investing. Okay? No one declared the first three. I'm creating that. I made it up. I said, hey, you know, I looked at the data and looked at patterns. I said, looks like there's pretty three distinct eras. I'm going to call it the fourth. So I called it Venture 4.0. And I said there's going to be massive course correction, culling, and focus. And we're going to talk a lot about that. We're going to look back to real invention, defensible real invention, real intellectual property, real differentiation, as opposed to a feature, which a lot of times can get funded and maybe even make it out. Focused on value investing. What's the difference between value investing and momentum investing? Value investing means I'm actually investing in a business that has defensible margins and real customers, as opposed to users, as opposed to a bunch of activity where you're like, we'll figure out the business later. And also value investing is not just investing in a nifty technology. There's got to be a real interesting business around that. And that's the biggest fail we see often in founders is they have a great technology, but either they can't bridge it to a business or the business waiting for them is not that interesting. Because remember, venture is a game of hits. At the end of the day, we can't build our business on 2 and 3X's, unfortunately, because there are a lot of good businesses to be built on 2 and 3X returns, meaning the return of what we invest in versus what we get back. We got to get 10X's, we got to get 100X's. When you look at venture in terms of what drives returns from venture, it's the outlier. It's that one deal. And it might not even be in one fund. It might be across vintages. If you're in Uber over 2 vintages, your LPs have done well, even if everything else tanked. And that's the game we're forced to play. So if you're coming in with a good business, I can't tell you the number of times in investment committee we say, that's good, that's not great. It's a good, not great business. And I guarantee you most of your ideas are good, and that has not a statement about you or where you go to school or anything like that. It's statistics. So figure out how your business is great, because that's the only way you're going to get the venture capital attention. And frankly, even if you get seed money or pre-seed money, it is no indication that you have a great business, because that money flows fast. The money that doesn't flow fast are the Series A, B, D dollars, A, B, C dollars, A, B dollars. Those are the toughest dollars, I think. Because when you get seed and angel money, they're just betting on you. Yeah, they hear your pitch, but then they're like, you know what? She's just really sharp. She'll figure it out, because most founders pivot 5 times before they get to a Series B or something like that. So all we're doing when we do a super early investment is saying, this founder's sharp, they're going to figure it out. It's a massive market, and they're a commercial killer. I used that term earlier today, commercial killer. That's the other thing. We oftentimes say, hey, this is a good, not great business. We also oftentimes say, the founder's not a commercial killer. Are you a commercial killer? Can you go convince customers to buy your product? Can you convince investors to invest in you? And so when you're pitching us, we're not just listening to your story. We're watching your ability to sell us. Because guess what? You got to go sell a ton more people after us. And if we don't think you can go sell other people, then you're going to run out of money. Because we're not raising that money for you. We'll try, we'll make introductions, but we can't raise that money for you. So we need commercial killers that not only can raise money, but can go convince companies to buy their product. So I got to speed up here to get through these slides. Here's the 4 phases. And again, I just made this up. I didn't make the data up. I made the phases up. And I made these cool names up. So 1.0, some of us, not me, I don't know if anyone quite here is from the kind of 40s to 90s era in terms of actively investing during that era. I call that the proto-tech pioneers. And by the way, can you guys hear me? Is this microphone okay? Okay, cool. So I call that the proto-tech pioneers. Think Intel, think computer chips, think early hardware, right? The invention of the PC. Then came the dot-com deluge. That's me. That was me with my pre-Google startup. That was Webvan. That was Amazon. All these companies that showed up. That was the dot-com deluge. Mass tech adoption was really driven by mobile. So it was still pretty niche-y, believe it or not, in the early days. And then with mobile, everybody had an app. There's an app for that, and everybody engaged. We all know that. We lived through that. Most of you grew up in that era. Now where are we? I call it the Renaissance realization, and that's a positive term, right? We're going to realize the Renaissance of technology. What does that mean? It means tech will finally start working for us as opposed to us working for tech. So instead of learning 15 different menu items and clicks and doing backflips to get something done, you simply say, go buy this. So like the Renaissance, there were the Dark Ages, and I think we're going to have some Dark Ages. And if we can make it through the Dark Ages and not all get scurvy, then it's going to be a nice Renaissance waiting for us. But there are no guarantees we can make it through. So that's why there's this big question mark. But look at this data. I don't know if I have like does this thing do the laser thing? Look at this. These numbers, this one right here, the number of VC firms. We go from 300 to 700. Okay, fine. To 3,000. This number, by the way, is now 3,200. This is US. And then you've got 17 billion, which seems like a big number, and 143. Okay, it's growing, and there's .com. $1.2 trillion in the asset class. I mean, it's ridiculous, the exponential growth, especially this is nonlinear when you look at the years. Obviously, you have that kind of Kurzweilian innovation curve. But here's the real kicker. Look at the M&A exits. Look at the IPOs. They've barely grown. So you've got exponential change here, and you've got algebraic change here. You don't need to be a math major to say there's a problem. And you'll see on a slide here in a second that if you look at this backlog of $500 million companies that we all value, okay, this business is worth $500 million based on our models and comps and all that. If you take all those companies in the industry and then you look at a good IPO year, meaning a decent number of companies going public in a year, there's like a 17-year backlog to get those companies public. That's never going to happen. And then you look at M&A, and there's not a lot of M&A. We can talk about why there isn't, but I believe a lot of it's systemic. So I don't mean to be a Debbie Downer because I love innovation, and there's tons of opportunity to make money, but we got to go in eyes wide open, and you have to understand this is the world we're facing when you're coming to us and asking us for capital. So we'll cover 4 quick things: the macro, the paradigm shift going on with AI. I usually call them platform shifts. This is a paradigm shift. What's going on in the venture landscape and what are the implications? So real quickly, the Fed funds rate, you hear this talked about. Why is this important? When I'm going to my limited partners and I'm saying, hey, you should put money in venture capital as an asset class, they have to look at what their alternatives are, right? Because if they're just looking for the return on their investment, we have competition. Well, when the Fed rate goes up, all the other interest rates go up, and they can make good returns by investing in other asset classes. So the higher the interest rates, the harder it is for us to differentiate. That's number one, because we come with tremendous risk. VC is the riskiest asset class out there. Number 2, the VIX. So this is a derivative of VIX. This is the, I think it's BlackRock, even though it says Blackstone, the geopolitical risk index. This is nuts. Now, this is back mid-25, but our volatility, the smart people that say where we are from a volatility perspective is at the same level as when Russia first invaded Ukraine or just below it, and COVID. Last time I checked, we're not in the middle of any major wars or anything like that. So there is massive uncertainty in the market. That makes people jittery, and they don't want to put money in risky asset classes when they're jittery. I mentioned this earlier, paltry exits. Now, oftentimes exits are cyclical. So the question is it systemic this time? That's what we got to figure out. Okay, AI is different. A couple, and by the way, these slides are available on LinkedIn. So here is the key takeaway. This is a paradigm shift. I do believe AI changes everything. This time it's different. It sounds cliche to say that, but this is not the printing press. This is not the loom. This is not internet. This is intelligence. Now, it raises an interesting question of what is intelligence? Am I intelligent? I mean, I'm just talking about a bunch of stuff that I've said in different forms, extrapolating words and putting it into cohesive sentences. Sounds a lot like GPT or an LLM, a large language model. So I think it's pretty darn intelligent. This focus of it like AGI and superintelligence, I think it's already kind of at superintelligence if it's probably smarter than 95% of what people can articulate in any language. So this changes everything. It's not only going to change things from a startup and innovation perspective, it absolutely changes the Fortune 500. It changes the entire industry. So I mentioned at the beginning, I think I mentioned that I have this investment business. I also have an advisory business. So I work with Fortune 500 CEOs, and I will sit down with them, and the conversation repeats itself over and over again. And that is, we absolutely are going to embrace AI first for efficiency and then for innovation. What's a code for efficiency? Jobs. How do I increase my earnings per share? I get rid of jobs. It's interesting. The conversations I have with them are not about if, but about how, and not about how, sure, I go through it. I'm like, talk to these companies, do this sort of thing. The how they're most focused on is, how do I look my employees in the eye and tell them to get behind this when it's their jobs that are going to be gone? It's a fascinating conversation to have. And I've come up with a decent answer to it, but there's not a great answer. There's a bunch of other kind of things here in terms of how I change the game. You guys probably know better than I do. You're living it. The one thing I said in the talk earlier today, you absolutely have to embrace AI. You have to be a master of it. You have to be an expert at it. Because if you're going to get hired, people are going to expect you know it, because they don't. But they're learning quickly. So whatever your practice is, whatever your industry, whatever your focus is, make sure AI is part of it. Embrace it wholeheartedly. And by the way, prompting is not understanding AI. You got to build agents. You got to automate. You got to be pushing as hard as you can. Even if you've got an idea that you're doing something in fashion or sports or whatever, figure out how AI is going to change it, and figure out how what you're doing is using AI and leveraging as much as possible. We have an investment in a company called Decagon. It's probably still fewer than 20 employees, and they are easily clipping 100, 150 million of revenue. They figured out how to use it. So this is agents. This is just a really simple concept, probably for the older people in the room, because all the younger people totally get this as like fact. But this progression of, we used to be human to human. Like, if I wanted to, like, you're a dry cleaner, right? Or maybe not a dry cleaner, you're a e-commerce company, right? And I call you and I want to buy something, you and I talk about it, okay? Now, next phase was, I call you, I talk about it, but you've got a computer helping you, right? So it answers questions. Or maybe you're calling me to sell me something and it's scripting you. Phase 2 down there at the bottom is, I don't get to talk to you anymore. Now I'm talking to, we used to call it interactive voice response, IVR, but now I'm talking to some sort of chatbot. And there was a human behind it that coded it. Phase 3, I now have a computer behind me, so I'm a lot smarter when I call you, and I know your competitor's pricing, and I know your policies, frankly, better than you did, so that's why I'm now dealing with a computer, and the policy is not even you. Because why have a human in the loop? When the lawyers have written the policies, the AI can read the policies and go to me, and then the natural place we all end up is AI talks to AI. And we were having a fun conversation with a founder in the room, how they're using agents to support lawyers, and the place we quickly went was, well, will there be lawyers at all? Or won't the agents just battle it out and tell us what the answer is? There's always going to be some human in the loop, but a lot fewer than there are today. This is something I put together early on with AI. This is kind of the cognitive load versus consequence of failure. I probably used AI to come up with those terms. But the bottom left corner are the most susceptible industries to be impacted by AI. I mentioned Decagon. Guess what they're doing? They're doing CRM. And they're annihilating call centers, just wiping them out. One of my little companies, one of my little e-commerce companies, overnight saved $3 million of EBITDA by putting Decagon in to change their call center. And that's the bottom left. In the upper right are judges and doctors and stuff like that. And this is just, AI is going to make a march. Bottom left, upper right. So as you think about the career you want to go into, the industries you want to go into, figure out where you are on that chart and figure out how it's going to impact you. Lawyers are on there somewhere. This is just the sheer scale of dollars. We all know that. This is super interesting. So this is why it's systemic. All previous platform shifts, we just like ran circles around the dinosaurs. It was a heyday. Like, we would just go invent something, and then we go steal their business while they're asleep at the wheel, and then we build big businesses, and then they'd have to buy us. Well, look at the left. The old dinosaurs were these old companies. The incumbents were not tech companies. You look at the top 10 global market cap. This is when I did it in 24. It's even gotten worse. All of them but Berkshire Hathaway are tech companies. And this is the tip of the iceberg. What's Goldman Sachs? My old employer, are they an investment bank? They got a lot more engineers than they do bankers. They're a tech company. JP Morgan's a tech company. So you think they really need you and your nifty little startup? No, they got a ton of engineers that are developing all sorts of things. So now the bar is much higher to a founder of how do you create something that's truly differentiated and that's defensible. And the VCs do our best jobs of saying, boy, you're dancing among the giants. How are you going to make sure you don't get stepped on? So if you come to us and you're like, hey, I got a better mousetrap for social networking. I'm like, yeah, okay, go. Because my guess is Zuck's already thought about that. And OpenAI might launch a feature tomorrow that could do that. And they have the go-to-market already nailed. The third thing we talk about all the time when we're looking at founders is go-to-market. So can that commercial killer find a path to go-to-market? How are they going to generate revenue? And if you don't have a clear answer for that, you get a nice little email saying, hey, we really enjoyed our time. We'd love to stay in touch. You're probably too early for us. It's usually what VCs say. Okay, quickly on the landscape. Hopefully I'm not teaching you anything on the left side. When you have the quality of supply fixed and the demand goes up, price goes up. Welcome to a bubble. Innovation is inelastic to capital. You can't pour more money on innovation. Innovation follows its path, right? So if you pour more money on it, then you got more people paying for the innovation. So prices go up. And we have absurd prices right now. We are in a bubble. I lived through the dot-com bubble. I saw it. We're in a bubble. I don't know how it's going to end, but we're in a bubble. The big difference, by the way, in this bubble versus the dot-com is the dot-com bubble played out in the public markets because companies like mine got public. We shouldn't have, but we got public and we had stupid valuations. In this case, a lot of companies aren't public. They're all staying private. So the reset is going to happen behind the curtain. And that's a good thing. That's a good thing for the overall economy, where it's not going to be dragged down necessarily, but what we saw with the dot-com crash. It's not a good thing for us, for innovators, for investors, because all of our marks, all the valuations are going to get pushed back down. There on the right, those are pre-money valuations. I mean, it's just obvious. Unicorpses. We've all heard of unicorns. So there's $2.7 trillion, $2.7 trillion of companies. And that, by the way, is now probably easily over 3 of private companies. And then over there on the right, this is that number I gave you earlier of half $500 million plus exits. It's just flat. It's not growing. So there's your issue. You got backlog and you don't have exits. This is showing that the amount of VC funds raised has fallen off because the limited partners aren't getting their money back because the system's not recycling capital, so they're not putting money back in the system. So that's what that chart on the left is. And then lastly, you've got the larger funds absorbing 70% of the capital, which we'll talk about in a second. This is the concentration of VC dollars, and you can see it goes into a handful of names, which I'll come to in a sec. This is the, so this is really interesting. This shows the percent of deals that make it past the early stage. And of the 2018 startups, you can see none of them have made it past the Series D plus round and IPO'd. And there are 39 live of the 1,844. So that's the journey ahead as a founder. This is not new. I mean, we all know this, right? The journey is really tough as a founder. This thing's super interesting. So just all this means is mid-cap private equity, the guys that go buy dry cleaners, car washes, roll them up, cash flow businesses, the returns for investors has converged on venture capital. That's a problem for venture capitalists because dry cleaners are a lot less risky than the stuff we invest in. And usually our outlier returns are much higher than PE, and they've converged. So if you're an LP, a limited partner looking to put your money, you're like, risk reward, I don't know. And so therefore you have to tell a very differentiated story as a VC. So here are the implications. So back to that fun little chart I made, I had some more fun with it with graphics. And I said, the prototech era was really craftsmen that would wrap their arms around a company and help build the company, roll up their sleeves. They made a real impact and they were specialized. This last era of venture capitalists are like assembly line workers. They're like, look at me, I'm a venture capitalist. I take the seed company and then I pass it. I'm the A investor. Now I'm going to pass it to the B. I'm a venture capitalist. And it worked because there was someone here to take your product. They're not there anymore. And so these assembly line VC workers are like, hey, wait, where'd you go? Stop the line. Stop putting more money in. And that we saw that happen over the last year or so. Speed of money was a real differentiator. From first pitch to term sheet, hours. I mean, that makes no sense. As somebody that wants to be a value investor, that makes no sense. And then there are tons of generalists. We just look for the quick signal. So I believe that we're going to see a shift. I think I put the logos on here. Maybe I don't. But I believe that we're going to see a shift back to craftsmen, back to value investing, slowing things down. And we already have. We've seen a lot of that already. Here's the bifurcation. You got the really big firms, Andreessen gobbling up billions of dollars. There's no way they're going to have venture returns with billions of dollars or historical venture returns, but it's a safe place for LPs to park their money. And then down below, you've got the differentiated VCs, which, by the way, they're of that 1,300 or whatever, no, 3,000, now 3,200 VC firms, none of them have very much specialization. So how do you specialize as a VC? A Venn diagram. You got to have the opportunity you're going after. You got to think about the competitive dynamics, and you have a right to win. It's hard. So this is kind of what are the ways to differentiate over on the right? You're a celebrity investor. You're the founder of Reddit, and you marry a tennis star. They're great investors, by the way, but that attracts VC dollars. I neither founded Reddit, and my tennis game is pretty good, but definitely not that good. You're very tightly focused. We focus on this niche. It's a big niche, and that's all we do. You are founders for founders. This is the squad that created Airbnb, and now we're venture capitalists. That's attractive. You're corporate. You're somehow aligned with the corporations, and you can drive revenue. You've got some sort of special access. We got a bunch of retired generals, and we're really good at defense investing. You can bring real differentiated value add. These are the things to look at. And then I listed them down the left, and I said, okay, within that, how do you really differentiate? If you're a celebrity and you're willing to do a tweet on the company, But if you're really if you're Ashton Kutcher and you're willing to roll your sleeves up and help create pop chips, that's huge. Way more than I could ever add to a company. So within those points of differentiation, there's a spectrum. And then I have I don't think this is on LinkedIn. If you're a founder, how do you navigate this Venture 4.0? You can take a picture of it if you want, if you're founders, but there's a lot in here. I talked about go-to-market. I talked about being a commercial killer. I talked about trust and traction. I didn't talk about trust and traction, but this idea of building the trust and traction, being a first mover. And it's this relentlessness on the commercial front. Preserve your cash. Your cash is so precious. And by the way, thank you, AI, you can be more efficient. However efficient you think you are, you can be more efficient. Lean into AI. If you can build a startup with 2 or 3 or 4 people, you can build a very powerful startup with 2 or 3 or 4 people and get to a point where the money will chase you. Don't expect the money to help bring success. You can get to success without the money. Don't scale it till you've nailed it. It's a good problem to have, but so many people have this issue. They go raise a bunch of money and they still haven't really had product market fit, and that's a problem. Get to know your potential investors early. Build a relationship early. If you meet somebody and they're like, hey, I don't invest in pre-seed, keep their name, keep them updated, keep them posted. Unless it's obvious not a fit, then don't bother because they're swamped with other stuff. But if you find somebody you're like, this is the person to lead my A. I know I've got another year and a half. Get to know them. Keep them updated. Diligence your investors. A lot of investors don't have any money. That's a weird thing about VC is it's 10-year funds. So they kind of stay in business, but they haven't. Ask them when they last raised their last fund. More importantly, ask them how much capital they have left to deploy. Ask them how big the check was, the last check that they wrote. Just be polite and listen, like read the website, but just ask those questions. Those are the only questions that matter. Okay. And then if you're an LP, which I don't think anyone here is an LP, and then for venture capitalists, not surprisingly, you got to find your differentiation and be ready to be told no many, many, many times. But we're already used to that if you're in the business. That's to my LinkedIn. I put all this stuff in LinkedIn if you want to follow it. I do have fun. I did get some awesome feedback from a student earlier because I've had fun with LinkedIn on making the pictures. I do all the cartoons. And I like think of fun, like little things, make a cartoon. And then I literally write every word. And this kid comes up, really smart kid, and he's like, hey, do you want a tip? I'm like, yeah. And he goes, your LinkedIn looks totally like AI just wrote it. He's like, stuff's too long, and those cartoons look like AI did it. I'm like, oh, you can't win. So anyway, I did write it all, I promise. But I'm not an artist, and I definitely did not make any of the cartoons. So there's an overview. Hopefully there's tons of questions. I know you probably have a few questions.
No, I'd love to open it up because he definitely set a good context. We never said that entrepreneurship was easy. That's why we exist. That's why the Office of Innovation exists, is to basically make it a little bit easier to navigate. But the reason we call a lot of our programs we do fitness programs, we call it capital fitness and entrepreneurship fitness, because you've got to kind of build up your muscles to not only build a company, but if you choose to invest in them. This is something that takes not only a skill and it's that you can learn, but it takes a lot of tenacity, perseverance. In fact, they found with great entrepreneurs, they found a greater correlation not to EQ or IQ with success, but definitely to tenacity and grit. The ability to grind through problems, but also take the feedback and read signals, even the weak signals back, and be able to pivot and adapt as you move forward. So why don't we open it up to some questions? Right now, because I'm sure
such wise words, though. I mean, like you guys, again, I can't emphasize how lucky you are to have somebody like Greg here, who's an active investor. I learned from Greg, for sure. So you're so lucky. And by the way, I'm sure I said some stuff you disagree with. So I'd love to debate that.
Should. Yeah.
Hi, Christy Anderson, MBA student, second year, president of the Venture Capital Club, Rady. You said craft was one of the new kind of industries coming back around. What kind of craft? Like, is it like eco buildings and modular homes? Is it like watches and jewelry? Is it shoes?
So by craft, I meant craftsman, craftsperson, as opposed to assembly line. So just that high level thing of like, are you 360? Are you thinking about the problem, right? I didn't mean actually arts and craft. I meant like, are you thinking about the problem 360 and helping as much as you can versus I take it from here and I pass it to here, which is what the industry became. So it's a return to craftsmen, a return to that concept of tooling and whittling and fixing and all of that. That's the romantic view of where we're going. I don't know if it's going to play out that way necessarily, but I think it'll at least move away from the assembly line. I see where you're going, yeah.
So I'm just curious if that was
what you meant. Well, I would put that in the bucket of defensibility. So Shinola has built something that is defensible. It has a story. It's genuine story. It's this craftsmanship that they're selling at a premium price. Like, that's defensible versus software. No one's investing in software anymore. Don't start a software startup. SaaS is dead because AI can write that software really quickly. So you gotta find the way to apply that. Applied software is great, but so that I put that in the bucket of differentiation.
Hello, Scott. Nice to meet you again. I'm Pavin. I'm an 18-year-old founder trying to be a founder. I'm working at a startup right now that's trying to raise 3.5 million pre-seed. But my question is, how'd you get into VC? What made you want to leave work you were doing before and transition into the VC realm?
Yeah, it's a great question. And by the way, you're not trying to be a founder; you are a founder. If you're here, you're a founder. If you're raising 3.5 million or trying to raise, you're definitely a founder. So, um, how did I get into VC? So I started, as I said, coding as a kid. I've always been kind of entrepreneurial and curious and all that. Those are good traits for a VC. Curiosity, because we see so many different things. We got to be thinking about the future, where it's going, how it applies, kind of intellectual rigor. Um, I had it early from probably being really bored. I wrote a LinkedIn post about boredom breeds creativity, and we're so overprogrammed right now that I think it's really important to be bored. Whether you do that through meditation or just go force yourself to sit in a room with no phone for 15 minutes, just try it. Like, it's just really important. In the shower, on the treadmill, like, stop input for a minute. Give your brain a chance to catch up. So I was raised with a lot of boredom, and so I kind of found my own ways to fill it. And then honestly, I always thought I had an opportunity to go in I had an opportunity to go into venture early in my career, and I'm like, that's an old person's game. And I said that for two reasons. One, because it was really boring in terms of it didn't work at the pace of Goldman Sachs or a startup, right? Like, you just are kind of coming into an office, you can hear the air conditioning blowing, you go to a conference, whatever. And number two, more importantly, I felt, and I'm definitely proven wrong by all sorts of great investors, that the best investors are the ones that had done it, as opposed to the ones who are hypothesizing. So what I wanted to do was, I guess 2020 hindsight, I set out to say I want to be an operator, I want to be an advisor, and I want to be an investor. And I want to invest and learn on someone else's dime. So I did that at Goldman. So nobody asked me at Goldman to start a fund. Nobody. They actually told me not to. They're like, your job is IPOs and, converts. I'm like, yeah, sure. But man, I know all these companies and I know where the industry's going. And I'm writing these thought pieces that we use internally. Because back then, no one talked externally at Goldman. Now it's like, can't not hear from them. And I said, we should be putting capital to work. So I started, again, no one asked me. I started going around the firm, finding places that had money and saying, hey, you should meet these Zappos guys. They're onto something. And I found like our specialty lending group to put some money into conveyor belts. They lent them money for conveyor belts, but I said, get some secondary equity. And Tony and Alfred sold some to Goldman, and that's how they got their stake. And then I did that again and again and again. And then the head of investment banking, who now runs the firm, came to me and said, hey, you're making all this money for other divisions. I'm like, that's because I have no capital. And he said, all right, well, what if we gave you $100 million and let you invest it? And I was like, great. Now, they didn't just give it to me. We put investment committee together and we did memos and all that. But I got to learn in that environment. It was awesome, awesome experience. And that's where I did Uber, Palantir Square, and Facebook and stuff like that. And so I think my personal journey, which is just an N of one, is get the experience. Because then when I sit down with that founder, I have a lot more to bring to the table than, why aren't you delivering? Send me your quarterly numbers. Here's 5 introductions of people I don't know that well.
The other reason it's really important is because if you're a good investor, the check is actually the least important thing you do for a company. It's what you do often before and after the check that kind of really creates that value, because we invest in the potential of ideas and the potential that this group of people, these crazy group of people, can actually pull it off. But all it is a little bit of data and a lot of hypothesis. And so what we do kind of after we write the
For
check.
early, for seed, early seed, the 100% that. And any seed firm that's trying to do more than that is kidding themselves.
Precisely. If you think you really have this magic crystal ball and you're kind of getting it right, because if you really are that good, I would say go to Vegas, begin putting on the table. You're going to do far better at that.
You might. There's no crystal ball, but you can have a crystal network.
That's right.
Like, if you could be playing the same, I could play the same VC game you're playing, right? Of like early seed, you're gonna kill me because I don't have your network. I don't have the talent in this room. I don't have the access. I'm not a professor. I don't have the platform that you have. So you're gonna get flow I'm not getting, even though we're playing the same game of picking founders.
In fact, we're seeing this rise of a lot of what they call solo GP funds, just these single people starting a fund, but they're surrounding themselves with these really intense venture partners and networks around them. to kind of augment and give them that lift.
We call them mafias too. Like you got the PayPal mafia, you've got the Palantir mafia, you've got the SpaceX mafia, and like these are the new kind of seed firms. And I'm jealous. I'm not. I'm not. And I had mafia on my list. I'm not part of a mafia. No one cares about the Look Smart mafia. That was the company that didn't do so great. It looks smart, but
I was wondering with the investment that is not getting returned, is it due to capitalization into data centers? And then another question is, would you mind sharing your investment thesis?
so when you say the investment's not getting returned, you mean the $3 trillion of investments that aren't finding exits? Is that what you mean? Yeah, it's not. Yes, a lot of dollars are flowing into data centers. There's just no, like, the only way we make money, there's three ways we can get our money out, right? One of them is taking the company public, and SPACs really soured the public markets on startups. So there are, what's that? A SPAC is a fast way of becoming public. So the normal way of going public is you hire an investment bank, you go market to a bunch of people, and then they buy your securities, and now you're a public company. A SPAC, you merge with a shell company that is public. And it was set up for the sole purpose of getting a private company to be public very quickly. I've done SPACs, meaning I've had my companies merge with SPACs. DraftKings was a SPAC, wildly successful. WAG was a SPAC, not so successful. Both public companies, two very different outcomes. So the only three ways we exit is number one, we take the company public. Number two, they get bought. Or number three, we sell to another investor. And when you sell to another investor, you're usually getting 20 to 30 cents on the dollar, unless you have a hot hand. If you have a hot hand, if you're in OpenAI and it just keeps going up and up and up, well, then you can get market pricing. But for the most part, all those other investments are just massive discount. They're bottom feeders. What's my thesis? Oof. So I'm a big investor in aerospace and defense. So I think from a TAM perspective and a trend perspective, that's interesting. I did just post today about aerospace and defense investing and how tricky it is. I have a picture of an anglerfish, and that's that fish with the big jaw with a little light, and then the minnows go to the light. Well, that DoD, the Department of Defense dollars, is the light, and it's really hard to make money in aerospace and defense. But so I do that. I've got a rocket company, a couple satellite companies. My current thesis right now that I'm just tiptoeing into is getting back into consumer and small business applications that are empowered by AI. But big caveat, I'm not getting anywhere near the giants. I'm not getting anywhere near Google, anywhere near OpenAI, anywhere near Shopify, because I just think the incumbents are way too smart. They can move way quickly. And any idea that I'm backing is just a feature if you're in their strike zone. So where does that take me? It takes me to some kind of more esoteric corners. Health is wide open. Those guys don't want to get near health. Too much liability, too much regulation. So run towards health. Like with Uber, when I invested in Uber early, I ran towards regulation. Everyone was like, are you kidding me? That's overregulated. You got the mob. You got every local, city has their whole issue with the taxi limousine commission. I'm like, I love it. Let's go. So you gotta kind of go for the hair a little bit if you're going to be playing anywhere near the giants. But that's kind of where I'm curious. Very cool. Please. For sure, the agentification of the world, 100%, and frankly, a lot of our jobs are going to be replaced. I believe that, especially kind of the top of funnel evaluation, and even the way we meet founders is so inefficient. I mean, you can't help but to think about like dating. And my wife and I last night were talking about with my nephew. We had dinner and we were talking about dating, and he's whatever he is, late 20s, and just I was saying it's a volume game, right? And a volume game with the right criteria. and you just gotta see a bunch. Same thing in our world. We got to see a bunch. So I think our industry is going to completely look different. So to your point, I totally agree with you. Like AI is going to impact us. It is impacting us. General Atlantic, the big VC firm, they on their website talk about how they have a AI partner, non-voting partner at investment committee. It's smart. We do too. We don't advertise it. It's just a laptop, but we ask it questions all the time during IC. But what is the TAM? What is this? What is that company doing? So coming back to your point though, craftsmanship doesn't necessarily mean you go slower. It just means that you have 360. You have the ability to help the company 360. And if going fast is critical to the company's success, then we will absolutely help that company go fast. If raising capital, project financing, more efficient capital, we know how to do that. If you're having co-founder issues, we know how to coach you or bring in the right people. If you need to hire a C-level person, we can help you do that. Like that's the mentality of like, we're here and we've got your back against any challenge you're facing. And if we can't solve it, we're going to bring in an expert that can in our network that we've worked with for decades. That's very different than an assembly line worker that knows how to move something from here to here. I get it, I screw a lid on it, and I give it to the next person. And if you ask me to do anything more than screw a lid on it, I look at you like, well, let me introduce you to our support team, our business services team. And you're like, who are these people? And why do they work for you? Like, because they couldn't get a job at a startup. It's just like, that model is not great. And so that's what I mean by craftsman. Not that we're going to sit down and like polish every pixel and, you know, whittle. It's more like we can come in with 360 support. And by the way, you got the best look for a co-founder. I mean, seriously, you got like your all black look, and then we've got beach volleyball guy here with, you know, I love the combo. I'm curious, you know, what your different roles are. Clearly. Clearly. Hey.
So I'm Pascal. I'm a founder, and this is my first week in the US. How do I bring a European startup to the US? Any tips and tricks?
That is a great question. Where are you from? Where are you coming in from?
I'm German, but I study in the Netherlands.
Okay. So I think cross-border venture is super interesting. I think it's a way we as a firm can differentiate. It's a way we as a firm do differentiate. I have a partner in Copenhagen, and we were talking about silver circles instead of crystal ball or crystal circles. We have a crystal circle in Copenhagen. Now, it's small, but we own that market because we have a really talented partner there. And I love this idea of like, we meet these companies a lot in actually kind of synthetic biology and some kind of AI automation in labs have been built there, but they need to come to the US. And so having a partner that can help you do that, a venture capital firm, I would put that absolutely on your list. But in terms of like what you do as a founder, moving here is your first step. Unless your idea is market specific, which there are a lot of ways to differentiate within the market, you got to go to fertile grounds. This was Israel's biggest challenge. There's so much talent in Israel, but for so long they tried to win in consumer. And I think Waze is one of the only companies that came out, but no move to the US. So really understand what is it that you want to build and what is your market. And if there's a unique advantage by being in Europe, then double down on that. If there isn't, get to a big market. US is one of the biggest markets. So come to these things, surround yourself, put yourself out there, and look for people that can help you with that transition as you start getting more traction.
Hi, Scott.
Hi.
My name's Katie. I'm a first-year MBA, and I'm part of the Venture Capital Club here. I'm hoping to be an entrepreneur, but also really interested in looking at it mainly from the investing side right now. So I guess for someone who's earlier in their career, what do you think is the best value like someone like me can bring to a firm? I mean, I don't have like the technical expertise in a specific niche. I feel like I look at everyone in this room and it's like full of people who are just as accomplished, if not more than me. How can I kind of really make sure I'm adding value?
I think it's tough.
Yeah.
I really do. That's why I didn't go into the job, right? I wanted to go do a bunch of other jobs before I went into it. I think it's really tough. Like, we hire junior people. when we hire them, they typically have done a couple years in consulting, maybe investment banking, but usually consulting. They're crazy smart. They probably have an engineering degree of some sort. They have a network that we don't have. Because at the end of the day, we need differentiated flow. Back to the crystal circles or whatever we're calling it. I made up that term. Like a mini mafia. So when we fill this next job, because we'll hire an associate here soon, we're going to look for somebody who is probably in San Francisco, has grown up in and around the AI community, and has some theses, and probably tried to start a company and failed, and worked at McKinsey for 2 years. Like that to me is an interesting profile because I can put them out there. I'm not going to those late night poker games that the kids are going to. So, but I need to understand what's going on, and then they hopefully will bring stuff back. And so it's sourcing. The other way you can get a job is kind of the processing side of things. But honestly, AI is really creeping into that. And I think it's hard to truly differentiate yourself unless it's a specialized firm and you have a specialization. It's a firm that does biotech and you are a double degree engineering, pre-med, and you studied a particular area, and that's the area we're interested in. And it's like, okay, cool. But being a generalist and going to generalist firms, I think it's tight. It's really tight. And I don't say that about UCSD. I say that to my daughters. I have 2 daughters. We have 2 daughters, a senior and a sophomore in college. And the advice we're giving them is find a niche that's defensible around AI. And both my wife and I did investment banking out of undergrad, and we advised our daughters not to do that. A, because there's no role models for them in investment banking as females, to be totally honest. And B, those jobs are getting pressure. It's a shitty life, number one, but there's a lot of pressure coming from AI on those jobs. You learn a ton. But if you want to go into like private equity or later on finance, it's a great boot camp. But beyond that, it's tough. And so find your niche that you think is interesting and really, really build defensibility around that. It's a higher bar than it was when I was looking for a job. It really is.
Hi, Scott.
Hey.
My name is Ravant. I have a primary background in robotics. I did my bachelor's in robotics, worked on a robotics company in the industrial space. You mentioned that it's one of the deep tech spaces you're looking at is robotics. Yeah. And so I'm curious on what's specifically within the applications you're looking at, because right now, all the hot topics is humanoids, right? Every company's trying to do humanoids.
We've seen so many humanoid startups, and we passed on them all.
And that, I think it's a wonderful aspect, but there's more to it than that. And what specific industries do you see where there's application?
The problem, so humanoid robots, right? Us as robots, Elon Musk, take over the world thing. Yes, they're going to be massive. They're going to be everywhere. And I really do believe that. And raise your hand if you've been in a Waymo. Okay, find your way up to LA and get in a Waymo. Just do it. Like, do a field trip. It's only a couple hours. I know you can read about it. I know you can kind of like talk about it until you do it, and you still haven't yet, right? Until you do it, you won't get it. And now you will also see Waymos everywhere. Like you go up to LA, you'll see a Waymo every 5th car, and you're like, holy shit, this is happening really fast. San Francisco, it's like every 3rd car. I'm exaggerating, but you get what I'm saying. And you're also seeing them turning up the dial. Initially, Waymos would sit there with their 4-way blinkers on behind a UPS truck for 5 minutes. Now they accelerate. And you're like, oh, this is getting good. So the same thing is going to happen with humanoid robotics. I'm convinced of it. Very soon, it'll be commonplace to walk down the sidewalk and, oh, I'm sorry, just like, sci-fi movie. And it'll get out of your way, and some jerks will push it, and it will stumble, but it'll have a little backpack, and it'll be jogging, and it'll be bringing you your chicken or your whatever, your dry cleaning. It's all delivery. And then they're going to show up in your house. They're going to do laundry. Like, this is going to happen. So why aren't we as venture capitalists investing in it? Well, because it's really hard to pick a winner when you've got so many people going after it. It's going to require a ton of capital to win. And you've got the gorilla like Elon and I think soon to be Zuck. By the way, Zuck's glasses that are really cool, he's training humanoid robotics, obviously. It's capturing, it's the same thing as the self-driving cars capturing, or the Tesla capturing all the video. His glasses are capturing tons of video of what will a robot see? How will it interact? How will it move to the left or right? It's like obvious, right? But how do we invest in that as a venture capitalist? It's really hard because you've got Tesla and you've got Facebook, and this is the dancing with giants. So therefore, We have to look at tech or components or pieces of it. But then all of a sudden you're like, wow, this is a small niche. So I'll tell you a company that we were really excited about, we almost invested in, but we didn't get there, unfortunately. I would have liked to have, was an agricultural robotics product that was specialized in weeding and then moving beyond weeding into other parts of ag. That's interesting because they have their niche. They're going up against John Deere. I can handle them. I'll take John Deere on versus Tesla any day. And I mean, not to ding John Deere, but they're no Tesla, right? Tesla's all engineers. And they were getting traction. And the big question was, how are they going to sell to farmers? And that was like the big question, right? Are they going to go a Tesla model where they sell direct? Or are they going to try to sell through the dealers? The dealers are controlled by the John Deeres of the world. So they have to go direct. And that's what we've been watching all along, and they're showing great traction. So find your niche, and make sure it's big. And then it gets to be an interesting robotics play, at least from our lens. I got to get a question out of Indy 500, by the way. I mean, she showed up with the Indy 500 T-shirt, so. But anyway, Sarah, go ahead.
Hey, my name is Desmond. I'm actually an MPP, but I am interested in like NGO. Can I put this down? This feels.
I can hear you. Just talk loud so these guys can hear you.
I'm more interested in like NGOs or kind of multinational, like MNCs. And I had a question more about sort of the whole process of like M&A, and then sorry, I have a lot of notes. It's kind of a complicated question.
Just put it in GPT.
Yeah, that's what I should do.
And then ask me in the next. Have a GPT summarize your notes, and then say what would be the best question based on these notes.
No, so I guess I'm thinking about startups that are coming to VCs with interest in non-capital investment. So that might be something like looking at trying to find co-founders or experts, or really just bringing in some people for assistance, like using your network, so to speak. And then also considering like within the process of like being a VC and trying to assess a firm and understanding that maybe what they're doing in a market doesn't work perfectly, and then you want to maybe, let's say, go to some of the other firms that are in your network and looking at sort of the tech or some of the other, well, really it's tech that's within that network, and then bringing it to this existing firm that's trying to have a better existence within their market, I guess you'd say. And I could see that.
So you're trying to solve venture capital?
Is that what venture?
I don't know. I mean, like a lot of what you're describing is the stuff we try to do.
Yeah.
So what is the? Give me the.
Well, because there is a current business model for these firms that are seeking that investment that is non-capital, and you want to avoid disrupting that, even though you might recognize that their current business model is not perfectly optimized. So then I guess I'm trying to understand. I mean, with your last point talking about John Deere and having firms sort of moving within markets to be more competitive, but I feel like that transition point between like adopting that new tech, but then also maintaining like the current business model, there could be some friction there that might lead to some lost profits. Sorry, I'm a public policy. I mean, this is not my language.
No, it's but try to ask it in really plain English, like 5 words. 5 words. What's the question? How do incumbents win? How do you beat an incumbent? How do you?
I guess the part that I'm looking for is what. Well, actually, that was on the previous page. So as a venture capitalist, venture capitalist, is that what it's called? Sorry, I used to play a game called that. How do you assist firms that are seeking non-capital investment?
We don't.
Never. Because how would you?
We wouldn't make money. We got to put capital in. That's what consultants are for. But they'll charge you. But no, we only can help the companies that we invest in. But Greg, you gotta disagree with me on something. I mean, I know you do. You're just too polite.
I can disagree with you.
Oh, great. Excellent.
All the time, yeah. I was in a Waymo, and the first time it scared the bejesus out of me. I mean, it's quite an experience. It's great. Um, in terms of new models, I'm going to ask a really dumb question here, right? So, most new therapeutics in the future are going to come out of China. China. Um, therapeutics. I'm a biology guy, right? Therapeutics are the good types of drugs, I guess. I don't know. Pharmaceuticals. So cancer drugs, metabolic drugs, all those kinds of things, right? So most new drugs, most first-in-class, as they call it, drugs, are going to come out of China, not out of the US. And it's not that they're copying us. Their research is also actually becoming better than ours in some ways. I mean, Nature now says that the top 10 research institutes are Chinese. Only one of them is in the United States. So China is doing things better, faster, cheaper than we are. And the same can be said in renewable energy, automotive, maybe even tech one of these days, right? So the question is, if we're to stay competitive as a country, can we afford to keep doing this venture model? Or do we have to rethink the whole thing, throw it all out and start again?
I love that question. Nina, are you rolling your eyes? Am I vindicated? I can't. I took. So again, we have two daughters, and we took them to China 10 years ago, like 8 years ago, and the amount of crap I get at the dinner table of my girls and my wife being like, "You love China. You want to be communist." And I'm like, I don't want to be communist, but China's got it figured out. I'm couldn't agree more. Here's my issue, and I don't want to go too down. I don't want to go too far down this path. Every system is an experiment. Democracy is an experiment. Capitalism is an experiment. Socialism is an experiment. And there's different flavors of them. And we've tested capitalism and democracy in our country. And we've pushed it pretty far, farther than anyone's ever pushed it, by definition, because they're pretty new systems. And a couple things. I think we're starting to see that unbridled capitalism and unbridled democracy are problems. The systems obviously kicked communism and socialism's butt in the last era. But letting them run free and unbridled is scary. We're starting to see the wheels wobble. That's number one. Number two, our system does not have adult supervision. What do parents do? Parents raise children, and they think about the children's future, not what the next quarter earnings are going to be, not whether or not they're going to make it into the next grade. They're thinking about where they're going to graduate, who they're going to become when they grow up, how are they going to spend their life, their career, how will they be safe when they grow old. When was the last time you heard a US politician talking about that? And that's scary. When was the last time you heard a business leader talking about that? So this idea of unbridled capitalism and unbridled democracy, I think, is a problem. I don't have a solution. And communism and socialism is not the solution. But a controlled economy, as we've seen in China, and they are not without their problems, has proven to be very powerful. And if you haven't been there, the good news is you don't need to go. Just go watch some videos. Look at their transportation network. Look at their factories that run 24 hours a day in the dark. Look at their sheer output. Look at the innovation they have on EVs, electronic vehicles. It's better than ours. And if you think you're going to go visit China and get off the airplane and be like, ha, look at the street vendors and look at this old, gateway connected to the plane and it's falling apart. When you land in America, you're going to be like, oh my God, our country is old. This shit's broken. I'm not saying their system's better. I'm not saying that their totalitarian approach is a better thing. But to your point, they have a bigger sample size than we do, and they're doing crazy good research. So, do we reset venture capital? Yes. Do we reset capitalism? Yes. Do we reset our democracy? Yes. Like, I think the whole system needs to be rethought. Because right now I feel like we're just racing off a cliff. And somehow fighting each other along the way. Blaming each other for all of our problems. It's not a good formula. So anyway, I'm much more positive. I'm actually a really positive guy. But I do think we have some real challenges to deal with as a nation. And you guys, have to help us figure this out because we've screwed it up. Our generation, we screwed it all up. So we need your help. Literally, I mean that like from bottom of my heart. We need your help solving this.
Hello, I'm
Hi.
Shubham.
On that note,
I'm a first-year undergrad, also founding engineer at a startup working on like hyper-personalized AI. Can you go back to the slide with the 1940s, 1990s dot-com bubble, and then now new renaissance? You go back, yeah, one forward.
this guy, or do you want the one where you can actually read it?
No, the one you just showed me.
Oh, okay.
Okay, this is for venture capital. Do you think this tracks with founders? How does this look for founders? Because I can see many similarities between the assembly, speed, generalist thing within founders.
Yeah, the slide I think that's more interesting for founders is this one, which I kind of stumbled through a little bit. So this is the journey of a founder. And it shows of the 4,369 companies that were incorporated in 2018, their journey in terms of raising capital. And I think this tells a really interesting story about how many actually make it. Now, they all don't need to make it to Series D because some have IPO and M&A prior to that. But when you look at the sheer numbers there at the bottom, you see just the paltry statistics of 34 basis points, less than 0.5% actually go public. And then M&A's 5%. And by the way, not all M&A is a good outcome. It's nice to be able to say you exit with M&A, but a lot of times it's soft landing, as we say. So the founder journey, I think, is different now because the money's contracted. VCs are basically concentrating their dollars in the winners because the LPs are concentrating their dollars in the big VCs. It's all happening, right? There's like concentration among winners. And then I think the money's still flowing in seed and pre-seed, but there's a ton of false positives, as you see in these statistics, in raising money at that level. So as a founder, you have to do the work for the venture capitalists. You have to be thinking ahead, and you have to be maniacal about not only pursuing your vision, but pivoting and keeping an eye on the market, but also driving hard at whatever your idea is. And honestly, it's a lot of luck. It's a lot of luck for us, and it's a lot of luck for you. Some things can go your way, sometimes things don't go your way. And the key thing is you just keep trying until it's clear you should stop and then try something else.
A lot of the success depends upon, there is that randomized luck, but there's also that kind of opportunity meets preparation kind of luck, where we say it's like a lot like building an airplane. You can do everything perfectly in building your airplane, but the minute you throw it up in the air, there's all these forces against you that you hope that what you built can withstand and align with these forces, but sometimes the forces do take you down. Sometimes there is a bird strike that hits your airplane, and you have to appreciate that.
Yes. So, Scott, I have another question about something you said maybe 5 minutes ago. In my mind, when you were talking about China, it kind of triggered this question about, do we need legislation to change first in order for innovation to continue? And I'll give you an example. I lived in Germany for 5 years. Renewable is very big. I lived in the state of Bavaria. The power company was forced legislatively to buy power from anybody who produced it with renewable resources. And they built a projected sliding scale of if you invested early, you got the top dollar. If you invested in 20 years, you got the small dollar because the technology would be cheaper over time. In California, many times renewable energy companies have tried to do projects, tried to change, people tried to get households with solar. You can't really get this European model started here because legislatively it's not enough to force the power company to buy it from somebody who produces. It's too strong. So the question is, do we need legislation first for innovation to continue and be more create new business models?
It depends when you're working. So we have seen that with both policy playing in when you're emergent or early on into something that is very capital intensive, and you need that early adoption. I mean, you saw that with electric vehicles and a lot of the tax subsidies that went into it to try to stimulate the demand and basically make it acceptable for people to accept it. You definitely see that. It's interesting that what you say though is that even the way a lot of countries like Israel initially, started their flywheel for capital, and even when a lot of what we look at venture started in the defense industries and the war efforts, where we would put all the R&D money into the front end of the process, but then we had a guaranteed buyer on the back end for it, and that kind of primed the flywheel for a lot of things. And then we came up with the speculative venture model where we build things and then see whether the market will accept and adopt them, and then we use narratives in marketing to convince people that this is a better solution or a better mousetrap for what they're doing. So there's opportunities for both models in the market when you're trying to get people to adopt something. Where if you have a visionary, let's say, set of policymakers or government that say this needs to be the future, this is definitely the pathway, or the way we're on is not sustainable, the way we're doing, then it makes sense to put both policy and capital to work to try to simulate behavioral change. Because very often the most difficult part of innovation adoption is political will and behavioral change. Everyone desires change. If you ask people in a room, how many of you desire this wonderful new widget? Everyone will raise their hand. And then when you ask people how many people are prepared to change and will prepared what they're doing, people will put their hands down.
If I were president, whatever, and I could make a decision, I would outsource innovation and I would influence adoption, to just summarize what Greg said. So I think I'm a firm believer innovation should come from the bottom up. And I'm a firm believer that to get rapid adoption, you need assistance. So regulation in the form of carrot, not stick, but you can also use stick against stubborn industries. But I do believe innovation needs to come from the bottom up.
And I counted that it's kind of like a snow globe. Sometimes they do have to do this. Sometimes demand comes from the top, sometimes it comes from the bottom. And it just really depends. Again, like if we want to build new renewable energy strategies or stuff like that, you can create a framework because there's so much uncertainty and ambiguity. Plus, in the complexity of large things where it requires an entire chain to work cohesively together, you may have the perfect solution right here, but if the rest of the chain is not aligned, we saw that years ago with algae biofuels. We looked at a company that had a superior strain that produced a higher percentage of algae oil in their strain. The reason we decided not to invest in it is because we were not sure there's a whole supply chain that works in there that we have to then hand this off to refiners. Refiners then have to put it on trucks and do it. We have to be assured that the entire market system is aligned to do that, that even if we do our one part. And so there are investment firms that are much, much bigger that try to look at these more complex and existential systems. It just historically is not what venture does particularly well. One, because they don't have the capital necessary to do it, and plus it's just so much more complex.
Can I ask just a random question of the audience? How many of you raise your hand if you think you're going to be more successful than your parents?
All right.
That's great. That makes me happy.
Really
that makes me happy. And how many of you think the system's rigged is too strong of a word, but like the system's not really built to help you? You got to break through the system. That's great. Well, that's ambition, to know that you've got those headwinds and you think you're going to be more successful than your parents.
And that mindset that you just exhibited is exactly what you need. adopt our products with the same fervor and loyalty that you see in large social movements.
So anyone have a question on their mind that they haven't asked and they're like, I wish I could ask this, but I don't really want to because. Okay, good. I like provocative questions.
Well, I don't know if this is provocative
Vulnerable
or not,
questions.
but maybe. Theranos and Elizabeth Holmes was so successful in raising money, but then couldn't deliver on the promise. I'm curious if you saw a change in the relationship between investors and founders following the sentencing of Elizabeth Holmes, and if that's changed Silicon Valley.
Where are you going? Oh, I thought you were running away from that question.
That's always happened. Of course, she certainly crossed, the line that she crossed. But entrepreneurs have always pushed the boundaries quite hard. Did you have on one of your slides the fake it till you make it kind of thing?
That was this morning
That was
or earlier today.
One of the things that entrepreneurs have always put forth is the kind of fake it till you make it. Where that would be totally right is that everything was very unethical. In fact, colleagues of mine had looked at that deal and they came to me and they said, everyone should run away from this deal back then. And I said, what was your first signal? And he goes, look at who they put together as their board of directors and their board of advisors. Not a single person in that had any knowledge of that industry.
No one blamed her.
Oh.
The only people that blamed her were her investors. Everyone else in the industry blamed the investors. Because we're like, duh, like this doesn't work. And so it was it almost emboldened the industry more than scared the industry away.
I agree. Who else?
Anyone that hasn't.
Asked a question yet. And anyone who has a kind of a provocative question.
Yeah, I like vulnerable, provocative questions. None of this like, what's the future of consulting? Not that anyone asked that question.
Hey, Scott, thanks for sharing the insights. I'm Giorgio Patsky. I'm the founder of Happiness AI. We want to make the world happier with AI.
I love it.
And I have a question. You mentioned that the next era is about value investing. How do you create value in the era of AI? Is it by making AI create value or building AI that understands
just
value?
to be clear, by value, what I mean is looking at the fundamentals of a business versus a momentum investor. So it's a much higher level, kind of like the way I wasn't clear on Craftsman. Like it has nothing to do with crafts. It's just this idea of like hands-on versus assembly. When I talk about value investing, I mean actually looking at the fundamentals of the business. Believe it or not, a lot of VCs don't do that. They pretend to, but they're just momentum players. And they make a ton of money, and they're smarter than me. But we're not momentum investors. A momentum investor says, hey, there's no stopping this freight train. I have no idea if OpenAI is going to build that or do this or do that. I just know they're up and to the right and their users are huge. I'm in. I'm buying that logo. That's a momentum investor. A value investor will really sit down and say, what are the long-term margins of this business? How are you going to differentiate and diversify your approach to market and your revenue? Like those are the questions a value investor asks. So it's less about like, how does AI create value? I like your point. Maybe AI figures out how to create its own value, but that's what I mean by value investing versus momentum.
Hi, I'll just speak without the mic. I'm Sahana. My question was, you mentioned building a specialized niche would be probably better, a niche that embraces AI. Now, as a college student, I'm doing a lot of courses with coding, introduction to programming, which a lot of people know is a very easily replaceable skill. So how do you think I should be spending my time as a college student? Should I really be paying attention to these classes that I will probably not be using those skills in the future? How do you think I should find out this niche?
It's a great question. And you're lucky because you're just saying, hey, how do I get exposure to this? The people that have it harder, I'm sure there's several in here, are the ones that are CS majors. They got a rough road ahead of them because firms aren't really hiring junior coders anymore. And that's a problem if you're a CS major. You are coming at it from a different perspective of saying, hey, I kind of want some exposure to this and I want to learn it. So I absolutely think, and I don't know, maybe there's a course here. If not, there should be, of like CS for non-CS. Like the classic like science for jocks or whatever those things are. Rocks for jocks. Like there needs to be CS for non-CS, where you're going to come in, you're going to learn, you're going to write a little bit of code, you're going to learn about systems architecture, you're going to learn about what does GPT stand for. And by the way, it's not GPT, it's GBT. Or is it? It's GPT. What does all this mean? And like a course that teaches you that is what you need, right? So many people talk about Chat GPT, right? It's a weird name. Generative pre-trained transformer. And yet it's become a brand. Well, you got to understand what that means. What is a transformer? You got to understand that Google invented that a long time ago. And they published a white paper. Why in the world would they give it away? Well, they gave it away because Google almost was a monopoly. And if they dominated AI, they'd be done. So they said, hey, world, go create this, please, so we have a competitor. But by the way, we have a massive ad network, and we know everything about consumers, and we're going to win this ultimately. And we're going to play like the way the Chinese game play. We're going to have a 10-year or 100-year plan. So they needed so you got to like have this perspective, but it doesn't mean you need to know Python. But learning a little bit of Python, what is backend? What is front end? What's CSS? What's HTML? Yeah, you should know all that. But the good news is you can just ask your Copilot and your IDE and your development environment to go create it for you. You can go to Lovable and it will spin out some code for you in a minute. So there needs to be a course of CS for non-CS. And if it doesn't exist, go figure out how to create that for yourself. And you can do it all online. It's all free. And you can learn those things. So that's the first answer. And then you asked something else that triggered something. Yes. Okay. Great question. What comes to mind when you ask me that is don't raise venture capital. That's my first advice to any founder. Don't take money from me. Unless you think you're creating the next Uber, the next Snowflake, the next OpenAI, don't take money from me. You're much better off begging your uncle, begging the dentist, scraping by, and building something that you generate a little bit of cash, and then you use that to be a little bit bigger and a little bit bigger, and you have an amazing lifestyle business. As soon as you let me in, I'm like, let's go. Scale, scale, scale. And you know who's most guilty of that is Masa-san, the whole SoftBank fund, his whole thing. And I sat across the table from him multiple times. You sit down with him and he's like, okay, so you're going to be 100 million. I want you to be $1 billion. You're raising 10, I'm going to give you 100. And it just doesn't work that way. And when I first said innovation doesn't respond to capital, neither does growth until you're at that growth phase. In early stages, you're not, ever. And so the best thing you can do is just create a lifestyle business. Find a niche that you know something more about others, and take your CS for non-CS and say, hey, I can create an agent. I can create some AI. Like we were at a party last weekend, and I had this idea with a couple of fun people. I went home, and I created the app. And I shared it back with one of the people who were like, what? Like, you have the app? I'm like, yeah, it took like 2 seconds. And it's like an app that would have taken venture capital and months to build back in the day. You don't need venture capitalists. You do not need to be a CS major to be an entrepreneur. Arguably, you're better off without it either.
Well, can you hear me?
Yeah.
Yeah. Basically, the question I'm going to ask was about because I just introduced myself. My name is Aaron, and I am ECE. I am a master student in EC department under robotic check. Yep. So I'm gonna thinking my interest is into like how to making the automation factory more intelligent. So there is a thing. Do you think because currently the government, U.S. government want the factory back to U.S. And do you think that just like the fully automation factory will be the key solution for manufacturer to come back to U.S.?
It's a big question. That's not just an economic question. It's a sociological question.
Yeah, well, but I just wanted to just focus on the technological part.
Yes, I think robots are more efficient. I think automated factories are more efficient. I think they produce more reliable output. yes, yes, and yes. How we actually get that through the system with regulation, with incentives, without a top-down government, I don't know how that's going to play
Yeah.
out.
So the solution I'm gonna think of was like about to using the intent to using a multi-agent
Yeah.
to use a multi-agent robot to
Yeah.
just like cooperating with each other. I just make an example like a doctor robot and nurse robot. A nurse robot will just decide what he wanted to do just by just by
Watching.
watch how
You
doctor
remind me of conversation. So we had
acted.
lunch
And we
before
followed
this,
it.
and we were talking about how LLMs that build AI create their own
Yeah.
languages. Like you set LLMs loose, and they start speaking gibberish to each other because this thing that I'm using right now to communicate with you is very inefficient English. And so it creates its own language. So I absolutely agree that, and this is Elon's strategy of create a robot that can see and act like a human and just
Yeah.
let them loose. And then they're going to optimize. They're going to look at situations and say, there's a better way of doing this. They're not going to consult us. And so I do believe that path to automation makes more sense. There was a question way back here.
Yeah.
Yeah. You just yell. Uh, Power is definitely a challenge, but it is a solvable challenge. Nuclear is a great source of power. We have a big social bias against nuclear because of some historical accidents. The next generation nuclear plants are actually very, very safe. And there's a startup called Oklo. It's now a public company approaching $20 billion market cap, and they don't have a product. Now, I think the world of the company, and I love what they're doing. And if they are remotely successful at what they're doing, I think the power thing we're going to solve. I really do. It might be the timelines might be off a little bit, but we're going to solve it. The thing that keeps me up at night, that bothers me in my core. Have you guys ever heard of Abundance, the book from Peter Diamandis? You should read it. It'll put you in a good mood. He really talks about, Peter's a wonderful person. He's a dear friend of Nina and mine. He's a wonderful person. He is a true optimist. And he articulates very clearly how tech, and I truly believe this, can propel and save humanity. And so abundance is this achievable goal that we as a society have in front of us. The gap between us and abundance is the thing that keeps me up at night. And this is humans getting in the way. It comes in the form of policy, it comes in the form of greed, and it comes in the form of selfish behavior. It comes in the form of recklessness, lawlessness, all these sociological challenges. We don't have tech challenges. We really don't. China's proven that. We have sociological challenges. And that's what keeps me up at night. It's like, how do we mine that gap? How do we bridge the gap between here and abundance? Because somehow we've managed to stretch it in terms of our systems, our focus, our greed, our coordination, our collaboration. There are pockets of it that are really promising, but then you have some real problems. So that's what keeps me up at night.
And even beyond that, our technical operating systems have far exceeded now our human operating systems. And E.O. Wilson said that part of the problem is that we have, primitive brains, primitive brains, medieval institutions, and godlike technology. And so there just isn't this alignment yet. Last question. You'll still be able to come up and talk to him, but we need to kind of wind up.
Hi, I had a question regarding like going to other countries. So do VC partners of America, do they invest in countries that want to go outside and commercialize outside? and I have follow up after that.
Yeah, I mean, we do cross border investing, but it's usually the other way around. So we'll find a company. I mean, the reality is, U.S. and China are the big markets, right? And the bigger the market, the safer you are. Now, it's not to say you can't build a great business in Germany or you go build a great business in a smaller market, but there's more room for stumbling and pivoting when you're in a really big market, in a very developed market, where the business development channels are open and the sales channels are established and the advertising is there. So going into a different market typically comes, at least from most VCs' lens, after you've nailed the US. And then you take it elsewhere. And that's something we do a lot. I have a partner in the Middle East. That advisory business that I started has partners throughout the world, and we do that. And we think there's real value in it. You don't want to do that too early. You got to really nail the base first. And then there's some creative ways to go into new markets. Joint ventures is an interesting way to do it, because oftentimes you want to work with the governments of the new markets you're going into, and they want some form of stake and ownership, and that's a good thing typically.
Yeah, we were just over in China with Janus Innovation Hub supporting us through a plug and play, and they really value American startups kind of over other countries. But like with our field, with autism care, they're not even aware of that. So that sort of made us think, should we go to Europe instead? Because there's more of the mental health care over there.
I trust your instinct.
Yeah.
Like, where is the system set up to support the market that you're going after? And China's an interesting one. I've spent big part of my career, early days in China. And actually, I mentioned this, sorry, I sound like a LinkedIn advertisement, but I mentioned it in the post I wrote about Seoul, because I was just in Seoul a couple weeks ago. And China nailed it. They threw the doors open. They invited us all in. We were speaking. We were going to palaces. We were eating God knows what food. And they wanted our dollars. They wanted our ideas. They wanted our companies. Then it shifted. And it was like, oh, well, we also want to invest in our own, right? We want you to put money in Chinese founders. We want our Chinese founders to do joint ventures with your founders, not just take your companies. And then it shifted again to say, yeah, we don't need you. And there's a reason why Amazon, Facebook, Google don't exist in China. So that strategy they deployed was actually quite effective. But I think you're on the back end of the China spectrum, so I don't think they're that friendly to US startups, whereas Europe definitely is.
Okay, well, we're coming to the end of our time together. As I said at the beginning of this conversation, let this be the start of future conversations. For those of you who came here for the first time, I hope you enjoyed it. If you go to our website, innovation.ucsd.edu, you'll see kind of the whole host of programs that we offer. We try to do them on a regular basis, and there's quite a variety of them. But we want you to build your network. We want you to kind of meet each other, but also interact as much. We've designed this entire building to engineer the serendipity of just people coming together in different ways around different topics. What was so great about this conversation is we heard from people who came from very different departments and disciplines and perspectives and historical references. So that was great. And I thank you all for leaning into the conversation, because that's why it makes these interesting for us. And I want you to join me in thanking Scott for taking his time to come down from LA for this.
Thanks for having me.
We do. So thank you. Feel free to come up and chat for a few minutes with Scott before he has to head off.
Can we do a selfie with these guys?
Absolutely.
Oh yeah, if you wanted to. Here, come around. I think it's better come around this way. Ooh, that light's bright. Ready?